Then comes another lifeline, monetary policy. You know, I talked of the constitution, I'm going into economics. This is because across the board you have all this. You should be nimble about shifting from one topic to another. The other day we discussed international relations. So, you know, you should be pretty nimble, agile, jump from one aspect to another. You know? Monetary policy. So, what's monetary policy? You know, it's a money-driven economy. It's not barter. So, it's been so for thousands of years. The shape of money kept changing. So, the policy that regulates the availability of money in the economy, in order for prices to be stable, in order for economic growth to take place, and so on, that policy is the monetary policy. So, monetary policy is made by the central bank or any other dedicated authority so that the quantum of money available in the economy is regulated to achieve certain goals like price stability. You know, the examiner will see whether you will spell out price stability first or not, because according to the RBI Act, as it stood amended 2016, the objective of monetary policy is primary objective, price stability, non-inflationary economy, price stability, inflation targeting. So, regulation of the quantum of money in the economy so that certain macroeconomic objectives can be achieved like price. That is the monetary policy. Monetary policy. So, you have the definition of monetary policy. I am writing price stability here. So, who does it? Central bank does it. But in India, the work is divided between RBI and the Monetary Policy Committee. So, this is some middle of October, third week of October. 10 days back you heard the MPC saying everything is frozen, repo rate is only repo rate. So, the repo rate is set by the MPC, only repo rate. Rest all aspects of monetary policy are taken up by the RBI and MPC. What is MPC? MPC has 6 members. MPC, Monetary Policy Committee, has 6 members, of whom 3 are RBI. RBI governor, deputy governor, and someone else in charge of the monetary policy. 3. So, monetary policy committee, half is RBI number 1, chairman is RBI governor number 2, and in case they are not agreeing, RBI governor breaks the tie. So, it's all RBI, but then you have external members appointed by the government of India. They are eminent economists connected with monetary and fiscal policies, and therefore, technically speaking, you have to say that Repo rate, I'm coming to what is repo rate. Repo rate is set by the MPC. Operationalized by the RBI, but the rate is set by the MPC. They have to meet at least 4 times in a year, but they've been meeting 6 times in a year. They could meet often, more often also. So, the RBI, the central bank, is the architect, the author of the, monetary policy. The objectives we know: price stability, growth, exchange rate stability, exchange rate stability, financial stability, so that the whole financial system works normally, they don't fail, they don't collapse, and that will have a cascading impact on the macroeconomy, etc. So, financial stability, job intensity being promoted, that is the employment creation, financial inclusion, financial inclusion. This is what you want to achieve. This is what you want to achieve by monetary policy. Dharmendraji, the first one. We'll show the brief one first and then go into more details later. This is a brief thing, and then we also got a table, no? Yeah. First you have a look at this. This is very simple. Price stability. Economic growth and all this I have not done. I think the time is after 20 minutes. Just to have a first look. And then the table also let them have a look. Feel good. Feel good economics. This is detailed. In between there is a brief thing, no? Oh, this is hawks, doves, tools. No, you're going advanced. Initially. Oh, okay, not this. Oh, detailed. Okay. So you had your look. We'll switch off. Let's do some details. Let's discuss some details, and then you will find it negotiable. So, you know the objectives. And how do you achieve these objectives? There has to be a set of monetary policy instruments for that. Your objective is to make it to the civils. How? These are the instruments. You put them into action, then you are there. Similarly, the RBI also has a set of monetary policy tools. What are they? I'm going to write here. So, monetary policy tools, instruments, whatever you like to call it. Broadly speaking, quantitative, qualitative. Qualitative, quantitative. This is a broad classification. What is quantitative? Let me explain. This is the money you have in the economy. This is the money, 100 rupees. Economy. Everywhere, individuals, institutions, banks. 100 rupees, you want to make it 101. You want to make it 99. You're changing the quantum of the money in the economy. And the quantitative aspects of the monetary policy are done, they're handled by, SLR, CRR, Liquidity adjustment facility. This is where you got repo, etc. And then you've got open market operations. Whenever you have a doubt, don't think twice, interrupt me. Please interrupt me. Because this is a bit, just a bit, you know, people are interested in it and they would like to be abundantly clear. So this 100, this is 100 plus 1, 1 is simple number, minus 1, either. So make it 99, make it 101. What are you doing? You're changing the quantity. What instruments of the RBI help the RBI to change the quantum of money? These are the four. There can be another case where you have 100, same 100, 100 remains 100. But who gets how much and under what conditions? That changes. I'll give you an example. See, I'm a stockbroker. You are a bank. Market is, you know, somewhere around 70,000. But it will go on. Market is 70,000. I'm a stockbroker. You are a bank. RBI is worried. You know, the problem has just started there in the Middle East. Who knows, China could attack, take over Taiwan, because America is busier than it can afford to be. Ukraine, stuck. Here, stuck. And it's not even begun. So now is the time for China to go and take over Taiwan. Imagine, the world is in a crisis. Recession, this, that. So RBI thinks not the best time for the stock. That's RBI's view. RBI is a very prudent body. So RBI says to the stockbroker, don't lend too much. And. So 100 is 100, but who gets how much, at what rate, under what conditions? That could be regulated. 100 remains 100. In this 100, A, B, C, they get the money, credit. Who gets how much? All that. So quantity is the same. Quality changes. You know, margin required. We are little children in monetary policy. Let's grow up gradually. So quantitative and qualitative aspects of monetary policy, for which they have certain instruments, that is the basis for RBI's regulation of the money supply, so that certain goals are met. Now, we need to dissect each one of them and see what they mean, you know, conceptually and by numbers also. So we can start doing it right away. I'll begin with SLR. Statutory liquidity. I already had defined for you liquidity. Liquidity is money or near money. Money is that money you have, digitally or physically. It doesn't make any difference. The money that you have with you, and if you have a government security, liquid, near money. Gold is near money. So there are some assets, physical or financial, which can be liquidated. That is, they can be converted into money readily. So you add up all that money and the near money, and then you are looking at liquidity. Statutory liquidity ratio. So, we are talking about the instruments that the RBI has to regulate the money supply. What's money supply? The money that's available in the market at any given point of time. Total money, entire money, total quantum of money. So what is this SLR? There is this bank, bank. And what's the primary source of money for the bank? Deposits. And deposits are two types. CASA. See, what is CASA? Current account, savings account. You are a company. You must have some money in the bank as current account because you are giving a check all the time. And the bank is expected to honor your check. Their people, their AC, their fan, the office, all that. You've come with a check in the morning, you come with a check in the afternoon, you come with a check in the evening. They have to honor that. They have to give you the checkbook and all that. So all this means they are not going to give you any interest at all. Current account. Keep your money compulsorily, but don't expect any interest from there because we are serving you. Your capital is safe with us. CA, that is CA, current account. Savings account, which is, it will give you a bit of interest, 2%, 2.5%, 3%, whatever. That is the interest you get on savings account. Why do you require savings account? Same thing, but you won't get your money so many times like in the current account. Certain limitation is there, but not as liquid as current, little restriction. So, savings account. I need the money tomorrow, day after, so what do? I keep it in the savings account. Gets me a bit of interest and also liquid. So these are the most liquid deposits that the banks mobilize. And yesterday, the latest statistics have come about the breakup. So here, this is current account, savings account, and long term, that is long or medium, fixed deposits. Fixed deposits, that is, 1 year, 6 months, whatever, fixed deposit, that is called time deposit. These are demand. Demand. I told you any number of times you go to the bank with a checkbook and ask them, sir, I want to withdraw 100. They are statutorily expected to oblige you. So, demand. But I kept 100 rupees as fixed for 91 days, 5 years, all that. That is time. Time deposits. Time. So all the deposits of the banks, if you combine them, they can be classified into two categories. Demand, time. Time is fixed, demand is CASA. The latest statistics for 22 are current account 10%, savings account 33%, and that takes away about 45, and what you have is 55, that is fixed. The more the fixed, the more confidence there is. See, I have 100. I'm very confident about tomorrow. So what do? Put more in the FD because money keeps coming otherwise. I'm not so confident about tomorrow. FD means I can't break it. When I break it, I'll be penalized and it's not liquid. So if I'm not confident about tomorrow, I'll put more money in the savings. If I'm confident about tomorrow, I'll put more in the FD. That is how the human behavior, please, economics is behavior, human behavior, our instincts, etc. So this is, if the banks have 100 rupees of deposits, 10% current, 1/3 is savings, and the rest is term, fixed deposits. So these are CASA, CASA, and then this is the demand is the time. Now, so the bank has got 100 rupees of deposits, gross deposits. From there, certain deductions have to be made for them to come to net deposits. Demand and time. Gross, time and demand liability. Liability. See, you are a bank, we all put our deposits there with you. It is a liability. You have to return it to us. It's our asset, your liability. You lent it to a corporate. It is his liability, your asset. So asset liability chain keeps changing like this. So demand and time liabilities, gross, net. Certain deductions have to be made, and that's a technical aspect. We are least concerned about that. Our focus is on other concepts. Net demand or time or demand, whatever you like. Liabilities. So let us simplify from 100 rupees of all the deposits. After you cut out certain expenditures and commitments, whatever they are, you arrive at 99, which is your net. 99. Gross is 100. One is something as mandated by the law. So from the total net time and demand liabilities, you have to keep some money aside, invest it in certain assets that the RBI tells you from time to time. That's called the SLR. Presently, it is 18% of the net time, 18% of net time demand liabilities. NTDL, NDTL, the way you like it. 18%. According to Banking Regulation Act. (1949). According to that, the RBI has the power to set the SLR. So this 18% of the NDTL, what do you do with that? After all, you're paying a lot of money to the depositors, and the RBI says you keep aside something. A large quantum of that, or maybe the entire quantum of that, you should put it into government securities. Government security. Central government, state government. You have to invest. And you have invested enough within the 18%. Government securities, gold, cash. So government securities, you have a lot of deposits. RBI told you out of this 18%, the whole of 18% government securities, okay. 17 government securities, half is gold, the other half. That depends upon various criteria. So basically, SLR is equal to that portion of the NDTL which is mandated to be invested in the government securities, center and states. You know? Why? Simple. Government needs money. Government needs money. There is no dynamic, large market for it. Without this money, the government will come to a stop. And so tell the banks, you shall buy government security. So there is a guaranteed purchase of government securities with the help of which government can raise loans from the market. That is number one. Secondly, it also ensures management of the money in the economy. After all, deposits are flowing into you. You want to lend that. If you lend that, it could inflate. And so 18% to 19%, economy is red hot. Lots and lots of deposits. Inflation. Maybe you will give money to, the potential defaulters. They are not credit worthy. You are giving money because there is a lot of money. Economy is going to suffer. You are going to suffer. And therefore, I will raise the SLR to 19%, 20%, so that more of your deposits are absorbed by the government or gold, or keep it as cash also. If the gold is looking good, now the government securities are looking good beyond whatever level, then keep it as cash. What do? I don't want you to lend it. Why? Because it's going to inflate, or it is going to, you're going to give credit to those who are not credit worthy, and that can have a, severe destabilizing impact. So, these are the reasons why liquidity management, inflation management, growth management, ensuring the safety of the deposits, and ensuring that the government has access to adequate loans from the market. So, you have SLR for all these purposes. SLR can be 0 to 40%. The government is really looking for a lot of money, 40%. Beyond that, it makes no sense. After all, your deposits are with the bank. If all that is being given to the government, then what will the business get? What will the consumer get? So when the economy is in serious crisis, make it 40, hand it over to the government will invest and all that. Seriously looking for so much of, and remember, the money you are putting into the government securities is fetching you about 7% of interest. You are only giving 2.5% of savings, 5% of FD. So you are fine with investing in the government securities. And if you put your money right time in gold, maybe this is the right time because of Middle East. Maybe. But remember one thing, gold is a political commodity. Gold prices go up or down according to the decision of American president. I'll take 2-3 minutes of yours. See, the whole thing about gold is, Putin occupied Ukraine. Gold went up. Uncertainty, whenever there is uncertainty, go into gold because it's a time-tested metal. But then, American elections are next year. The heat is on. All the aircraft carriers and Biden and Blinken, all that is for election. So now, this is October, next year November. So just imagine, people are buying gold, even crypto has something modern about it. People are buying gold. When do they buy gold? When stocks are unfit, banks are unfit, and when government securities are unfit, they don't trust them. They don't know where they are going. This is the most trusted commodity metal. So let me buy gold and let me have sleep. I don't want huge returns as I get in stock market. I want to be safe. Let me go gold. Which means it is a slap on Biden's face, this side and that side. Your economy is not doing well. Stocks are not attractive. Bonds are not attractive. We don't know where to run. Gold is the only cover we have, and therefore we are buying gold. When people are buying gold and gold prices are skyrocketing, with what face can Biden go to the people and tell them, economy is doing well, vote for me another 4 years? So the political economy demands that gold lie low, except a month or two, maybe now. Maybe they'll decide. Managers will decide. Maybe for a month or two it will go up, but definitely not as we get closer to American elections. So that's the political economy, leave that out. So, SLR 40%, if the government wants a lot of money. Zero, I don't want any money of yours. My taxes are such that my coffers are overflowing. I don't need to borrow. If I have to borrow, I'll make it attractive for you. Why should I compel you when I can incentivize you? So 0 when everything is hunky-dory. 40 if we are in a crisis. Beyond 40, it doesn't make any sense. So that's the logic about setting the SLR between 0 and 40. And finally, SLR is a long-term signal. While you started getting serious about civils preparation, might have been a year or two, whatever, differs among you, the RBI hasn't touched the SLR at all. They touched the SLR 20 years back, 30 years back. Lehman Brothers crisis took place. That's when they had to. And then COVID, they had to. Little bit. COVID, I'm not sure. COVID they didn't touch. They were bringing it down at any rate, and they brought it down. So SLR is not easily touched, readily touched. If you lower the SLR today, make more money available to the business and consumption, SLR, then you are telling the whole world, that includes India, Indian economy is taking off. Be an animal. Don't be rational. Take the risk of the first order. Come, it'll pay off. But if you raise the SLR, then you think that either inflation is going to shoot up or investment grade economy we don't have. So be cautious. SLR is 19. Don't lend more. 1% more of the money is, directed and all that. So management of the SLR, long term number one, medium long number one, and it serves all the goals that the monetary policy instrument serves. They serve number two, and that's a signal. So tomorrow if the question comes, SLR this, that, what is the meaning, or when should SLR go up, down, this, that, I'll wait here for a few seconds. Take your time. Ask whatever you like. Don't think twice. This is not the topic where you think twice. Ask. Or you could ask after 10 minutes, 15, 20, 30. Dharmendra ji, one graphic on SLR. Monetary policy. SLR, okay, SLR. Till here it's SLR. This portion is SLR. Yeah, not this. Up to here. This. Oh, here, huh? Okay. Applicability. All the commercial banks, cooperative banks, commercial banks means all your small finance banks, all of them. And the payments banks have to keep 75% of their deposits in government safety. 0 to 40. So that's SLR. We will switch off and then go into CRR and incremental CRR. Incremental CRR is my pick for the upcoming prelim and of course maybe main also. So what is CRR? Cash. Reserve ratio. SLR is okay, medium, long term, 1 year, 2 year, all that. Right now, some cash has to be, extra cash, made available. Or you have too much of cash that has to be absorbed. So if there is excess, absorb it. If there is a shortfall, inject it. And you have many mechanisms for it. And you use all of them because they are all distinctive. They have their own refined use, nuanced use and all that. So, again NDTL. Net demand and time liability, 4.5% of it, you keep it with RBI. Keep it with RBI. In SLR, you bought securities, you keep them with you. You can use them for some purpose. That's your securities. CRR and gold is also yours, you keep it with yourself. Cash is yours, you keep it with yourself. CRR, that 4.5% of your 100 of NDTL, you have to keep with the RBI. And they'll supervise it some Friday, every fortnight, whatever. If you fall short, they'll penalize you. And if you're okay. So 4.5 you keep with the RBI. Why will you fall short? Well, you could fall short. You know why you will fall short? But then you can't fall short all the time and expect to be penalized and after that get away. No. You make a mistake, you'll be penalized. After that, just like between you and I, just like between, any two human persons, there'll be problems if you go on making errors. So, okay, 100 is what you picked up, NDTL. 4.5 rupees you keep with the RBI. Why? Same. I don't want you to lend. Tomorrow 3.5, 2.5, 1.5, 0. I want you to lend. The economy wants more money. There's a lot of growth. That is one way. 5.5. No, it's inflation. There is excess of money. 5.5, 6.5. So regulation of the CRR on a short to medium term basis is meant for price stability, liquidity management, growth related, ensuring that reckless loans are not given. What else? This is all you get. And based on that, interest rates also change. More money, less interest. Less money, more interest. So if I take away excess money, there is shortage of money, liquidity crunch, rates are higher. If I infuse more money by lowering the CRR, more money, rates are lower. You want the rates to get hiked, don't want to hike the rate yourself, but you want to do it by liquidity management, do it. More CRR, less rates. Less CRR, higher rates, regular stuff. Now, what's the law based on which you have CRR? RBI Act. 1934, kicks in 1935. Based on this. Remember the other one, SLR, we said it's based upon Banking Regulation Act 49. This is CRR. And you won't believe me if I tell you two things. 0 to 100. CRR limits can be 0 to 100. You won't believe me. I'll explain. Also, that 4.5 rupees out of 100 that I tell you, park with me, keep with me as a mandatory compulsion, I won't give you any interest because I'm not borrowing it for my commercial use. Why will I give you interest? I won't give you any interest. So two things. Does not earn interest. Does not earn interest. You'll be wondering, are you serious? 1 rupee deposit I have taken. On that who knows, maybe I'm paying 6%, 7%. I don't know, maybe. Of that 1 rupee, 4.5 paisa I have to keep with the RBI compulsorily as a CRR obligation. I'm getting nothing. I'm paying money there and I'm keeping it with you under CRR. I'm getting nothing. Is there some rationality here? Some banks want that removed, but that's another story. Right now it's there. The logic is I need an instrument with which on a continuous basis I can manage the liquidity so that the goals of the monetary policy are met. Because monetary policy has to be continuous. There has to be tax stability. Government of India can't tinker with the tax rates and slabs all the time. Whereas this, you meet every 2 months. You have to meet 4 times in a year. 3 months, MPC has to meet every 3 months. Has to. Why? Because you have to keep vigilant eye on the economy because inflation is such a phenomenon. Not only does it hurt millions, hundreds of millions, it also can derail the economy in multiple ways. So, you have to have monetary policy on a nimble basis. So, on a monthly basis, whatever, I keep raising or lowering the CRR or freezing the CRR depending upon the demands of the economy. Then, okay, it doesn't fetch any interest, that's okay. But you are still wondering, 0 we can understand because the economy needs money. Why? Keep it away. All the deposits you are mobilizing, you give credit and all is well. You won't be able to, rationally speaking, even if you think for a millennium, you won't be able to understand. What? 100%. What is this 100%? I'm giving money to get the deposit and RBI tells me all the deposits on which you are paying interest, keep with me, I'll give you no interest. You won't be able to because it is, I need to, contextualize it. I'll give you 3 examples. As recently as 2023, 3 examples I'll give you. One COVID example I'll give you, 23 example I'll give you, and another example post demonetization example I'll give you. All recent ones. incremental CRR. We'll come to incremental CRR. Otherwise, CRR is done. Comparative table, you may kindly look at it. CRR versus SLR. After that, we'll come to incremental SLR CRR. You're okay? Whatever you wanted to ask anyone, you could ask me about this. Childlike questions you can ask. Stump me with your, simple questions. Silly. Tomorrow you go to interview, the board member can ask you, what is the difference between MGR, NTR and SLR? He can ask you. You should, have that presence of mind. They are celebrities, sir, and leaders. This is a statutory obligation, sir, for the banks. You're okay with this? Or are you still on it? Can we go to the next graphic? Oh, yeah. Now, this is CRR. Incremental CRR, I'm coming to. Dharmendra ji, give me 5 minutes. After that, incremental. See, a few months back, RBI said that 2000 rupee notes, they are not meant to be permanently in circulation. We had some logistical issues. Therefore, we had to create 2000 notes and they are not being used well. So, we are, terminating them, their legality, etc. So, between, a certain period, you please go to the bank, either deposit the 2000 into your name or exchange it for whatever, other notes. It meant lakhs of crores of rupees coming into the banks, and a lot of them are there in the banks as deposits. Some people gave 2000 and took 400 or 500 and walked off. A lot of people kept it in the bank. Now, what is keeping it in the bank? At a certain interest. So, when I am giving interest, I will be quite eager to lend the money and earn my, earn some money, profit. But then, this is unusual money, it's not usual deposit. You're telling the guy, please go park your 2000 there and then it will not be in circulation anymore. He wasn't inclined, but rules are such that he had to. So, this is artificial build-up in the deposits, number one. And banks can't lend it, number two, because, economy doesn't require it. Some investor who is not lendable, but I have too much of money, he becomes lendable. And I have so much of money, rates also I can reduce. This artificial changes could spell trouble for the economy. So, RBI said between some date and another date, you've got your deposits. Those deposits attract 10% of CRR. Decide up to then 4.5. After that 4.5. But just this period 10%. 10%. Only this period. So incremental CRR applies to deposits in a given certain period specified. That is one example. Same example can be stretched. You know, some period between September to November of 2016 when we undertook a structural reform. That point also a lot of money came into the banks, and that money is involuntary, compelled money, and so banks cannot use that money for lending. That could again, you know, lend to the wrong guy, oh this, that, NPAs will build up, inflate and all that. So RBI said between this point of time, all the money that you attracted as deposits should attract 100% of CRR. 100. Why? That money is not normal money, not lendable. It can wreak havoc on the economy in multiple ways. So park it with me. I'll give you nothing. You know, you may say if you get nothing on what you are paying, is it not, you know, a loss making? We'll handle that. The RBI that told you keep that money will take care of you. It has no other alternative. It has to protect the macroeconomic stability, financial stability, and therefore told you all that money park with me. Those days, few months or whatever. Incremental CRR 100. So here, park more money with me. Here, park all money with me in a certain time period, both. But I'll give you one example where I'm helping you by zeroing the CRR. This is post-COVID. You know that tourism sector flat, hospitality, hotel sector flat, all the touch-sensitive sectors flat. You know, they could not make profits, they could not operate at all. MSME is flat. So these guys will wind up unless you help them. You're not ready to help them. So I'm incentivizing you to help them. If you give these guys, if you give, you know, your deposits are 100. You know, your deposits are 100. Right now you are lending these guys only 2. Lend them more. How much would you like to lend? 4. On all the 4 rupees there is no CRR. So you will, because once there is no CRR, your money is not being taken away without paying any interest. So today I am charging 5% for the guys I lend. Why? 4.5 CRR, I am getting nothing. Out of 195.5 is what has to fetch me all my profits, because 4.5 is taken away. So if I could otherwise lend at 4.8, I will lend at 5 because RBI took away my 4.5. Now, for these 5 rupees, 6 rupees, 7 rupees, 8 rupees that you are lending to designated sectors whose growth I would like to see revived, on that money no CRR. You don't have to hike the interest rate through compensation. So, interest rate, let it be low. One, you are promoting lending to the targeted sectors. Another, rate is also low. That is how by, you know, zeroing the CRR you are promoting credit for the given sector, and by making it 100 or 10 whatever, by charging more of CRR, you are achieving some liquidity management, price stability, etc., etc. So that's a concept of incremental CRR. Applies for certain types of credit or applies for deposits in a certain period of time. This is what we have seen with our own eyes in our own lifetime. We have seen incremental CRR 100, 10, 0 for deposits in a certain period or for deposits of a certain type. That's incremental CRR. Basically, if you put together the reason why CRR is 0, 10, 100, you will see you want to promote growth of certain sectors. You want to ensure there are no NPAs. You want to ensure there is no inflation, price stability is managed, etc. Same liquidity management goals. You have used extraordinary instruments. I'll wait here for a bit of time. You please take your time to, understand. Understand. Your only job is understand. That's all. Having understood, see the implications. How can a question come? These are the three-pronged exercise. Understand, implications, and how could a question come in the preliminary. Main, though I'm sure right now too also you can write about it. Main, prelim. Take your time. I'm waiting. If you have nothing to ask, I'll know. Yeah, incremental CRR, the table. See here. And there will be more later. For the time being, please satisfy yourself. I've given you 3 examples. I put only 1 in the table because this is meant to understand. Expand in course of time. Yeah. You've seen? CRR normally is a liquidity management tool of a short term, at best medium term. Long term, no. Long term, SLR. Now, you are saying lending. That's what lending is about. Liquidity management. I leave you with more, lend more. Leave you with less, lend less. Why? Inflation, growth, NPAs, whatever. So that's what the monetary policy is about. Ensuring money, adequate money. Different points of time, what is adequate? That differs. So ensuring there is adequate money. For what? Lending. For what? Investment. You've seen. Your question was about CRR. Yes. That's my answer. Incremental CRR is where the action is. I have told you everything. You cannot go wrong. That question and answers are in your pocket. If you go wrong, everyone else also will go wrong. That's no consolation, of course. But you won't go wrong. You won't go wrong. Even if, how tough can the question be, you please tell me? It can't be. This is as tough as it gets. That's all. Last 5 minutes, what we discussed is everything about incremental CRR. Unless you do a PhD, compare it to Germany and Zambia. Makes no sense. Yeah? you have to raise your.
In incremental CRF, we mentioned that it's used for managing lending activity. But,
It's used for
managing lending activity.
managing.
Lending based economic condition.
That is, banks have money only to lend. What else? Isn't it? But not only incremental CRR, I gave the example of, banks have the cash, impound it. Post-demo example I gave. Post-COVID example I gave. And then post that recently 2000 rupee note thing I gave. In all this, basically you're sitting on money, not voluntary money, abnormal money that can't be taken as a resource for lending, in which case lots of trouble will come. So hang on, same logic, isn't it?
That means that managing liquidity and managing lending activity is same.
Managing liquidity and managing investment, you mean the difference between the two? Liquidity is not necessarily all the time directly linked with investment. Today they are taking away cash from the economy because it's inflating. Investment is not on the horizon. There's enough money for investment. Inflation is where RBI's Arjuna's eye, yeah? Inflation. So after the prices are stable, then they'll switch their attention to investment. Investment is by definition long term. Now the focus is short term, geopolitics, geoeconomics. We don't know what's, Kharif and this and that, erratic rains. So prices is where the mind is set. Yeah? Liquidity. Investment is once the prices are stable and all of the factors fall in place, then investment. Right now we have to cool the prices so that investment follows. Is it not? You got it? Yeah, liquidity management. But that's a wonderful question. You wanted me to differentiate between the short term from the medium to long term. Investment is medium to long, for which the short has to be, in place. Anything we have to? Quantitative, okay. Take a good look. It's a simple table. I didn't use the term selective credit controls, moral suasion, because within 5 minutes of starting the class, how can I use big words? Margin requirements, I use the term, but explanation comes later, not now. Psychologically, simple words, basics, that's how we start. Anything else we have to show here itself right now? No, not yet, not yet. So, SLR, CRR, and a subset of CRR, incremental CRR. You know this. You can't go wrong on this. Nobody can make you nervous about this. Then let's see your favorite LAF, liquidity adjustment. You see, once we know, our friend who asked me about liquidity management, once we understand the basics, you are pushing me to differentiate between two things. That can take place after the basics are understood. And let me create some examples for that. And we will do it once the fundamentals are understood. Liquidity adjustment. Facility. So once again, see, you asked about liquidity management investment. Rates are high, you're managing liquidity, investment is also impacted, no? Who will invest in an economy where the rates are high? So you can't separate the two at one level. You could differentiate and separate the two at another level. So basically, price stability precedes investment is one argument. If you use the repo rate instrument for price stability, that is bound to impact on the investment, that is also a fact. There are times when price stability, following that there will be investment. Take America right now, rates have gone up vertically. For what? To stabilize the prices. And in the process, what happened to this European Union, Eurozone, that is those countries that adopt the common currency of Euro, 20 of them. Latest country is Croatia. What happened to them? They were known for zero rates or even negative rates. Inflation was high. They had to raise the rate to control the money. In the process, investment suffered and they went into recession. Inflation did not come down because the forces were on the supply side. So is it not the case that price stability, which is what you aimed at, took toll on investment? You know, directly. So you see, in what circumstances liquidity adjustment for price stability stops with price stability, and under what circumstances it will spread to the growth also, investment growth and all. I wanted to say, for example, in America, a lot of guys wanted to invest. Rates are high, don't invest. Why are the rates high? Repo rate. Why are they high? To get the prices to cool down. So, you know, there are two sides of the same coin. Cooling prices will automatically cool investment also, which takes the growth down. Prices and growth go down or go up together, like we have seen. So LAF, it has three instruments. Repo, repurchase. Repo means repurchase rate. Ready forward repo. Repo rate. Repo rate. Standing deposit facility. Marginal standing facility. Monetary policy notes is with you. Today it's given. No? Dharmendra ji, monetary policy notes today? It's in your hands now?
It will be given after the class.
After the class. From tomorrow we have to put it into their hands before the class begins. Marginal. You will get simplified, clear notes. 1 hour, 2 hours, you know, logistics is a problem. Marginal standing facility. So, RBI is the lender of last resort. Remember, there is a bank. It has a commitment for 100 rupees, big money. Nowhere if it runs into the market, rates will go up. If it is desperate. And if it cannot honor its obligation, the bank's credibility will go down. Banking operations will be impacted. So RBI is a lender of last resort. You try everywhere else, but if that is going to impact the financial stability, raise the rates and all that, come to me, I'll give you. You are in need of liquidity. You're not able to mobilize it. Come, I'm the lender of last resort. I'll give you money. You won't sink. I'll give you money. So that is the lender of last resort. Under the umbrella of lender of last resort, you got the Repo and the MSF. This is when the RBI borrows. I'm coming to all the three. The books you might have been reading, they may be telling you that Repo, reverse repo. In India today, reverse repo is there, but RBI doesn't use it. Repo, standing deposit facility. There is no reverse repo as a part of the LAF anymore. Repo, standing deposit facility, MSF. There used to be reverse repo, now it's not. So reverse repo is not there. I'll tell you why. That question also has to come in the exam. It has not come. That reform has kicked in last year. So what is repo rate? You know, repo rate is, you are the commercial banks, essentially, all those banks, cooperative banks. You are the banks, I'm the RBI. You need finance overnight. See, like personal life also, today I want 10 rupees, tomorrow I'll have 15 rupees. I'll ask my friend, give me 10 rupees. He'll give me. Tomorrow I'll give it to him, overnight. So short term, overnight. You are the banks, I'm the RBI. Come to me. I'm the lender of last resort. You bring your government securities. See, I told you, this is very important. You know, so this is 18%. 18% of your NDTL, 18% has to be kept in government securities, etc., primarily government securities. So, but generally, what banks do is, they invest more of their NDTL in government securities partly because of safety, partly because of attractive rate of interest, and partly because they can use the excess as collateral to borrow from the RBI through the repo window. So this is 18%. You've got another 3%. Why? I told you the reasons. So you want to borrow from me? You can do so. This 3% of excessive government securities over and above the legal mandate of 18% can be used as a collateral. Give me that security, keep it as a collateral, it's worth 100, so 75, 80, whatever I'll give you. Tomorrow you bring my money back with interest, and that money I will take, your security I will return. You know, this is a repurchase operation, repo. The rate will be 6.5, whatever. The rates are going up. They have gone up to 6.5. Who knows what will happen to crude oil and all that? So the excess of government securities, both central and state government securities, that a commercial bank holds over and above the SLR limit is useful as collateral for borrowing from the RBI in the repo window at the repo rate. So there is use. So this is repo rate. How much money will I give you? As much as I think I should. Is there a limit on quantum? Yeah. Who gets how much? Which bank gets how? Yeah. Everything is decided such that growth is enabled without impacting price stability negatively. You know, so that is the repo rate. It's obvious that the higher the rate, the lesser the investment. So I want to hike the rate. So you lend less because at such high rate there are few takers. When somebody wanted to buy certain things by borrowing, rates are high? No. Somebody wanted to invest by borrowing, rates are high? No. So the credit offtake is reduced because the rates are higher, and in the process demand in the economy slows, and thus prices settle down at a lower level. So repo rate operations, when they go up, going up is to ensure prices are stabilized. Going down is to ensure more liquidity is made available, more consumption, more investment. Obvious fact. Everyday life. Reduce the rate, more guys will take money, growth. Hike the rate, less guys will take money. Prices will behave and growth will suffer. So this is the classical trade-off between growth and price stability. Classical, so classic. We are watching it on the wall as it takes place in the Eurozone, America, UK. I don't want to talk of India because we are growing. When we are growing, so rates are also higher. So maybe we could have grown at a higher rate if only the repo rate was not raised, by 2.5 percentage points over a year, last year to this year, last May to say about July or so. So that's about the repo rate. You know it. Now, so I have allotted 100 rupees. I'm the RBI, you're the financial system. I have allotted 100 rupees for the repo loans. 100. But you guys want more money because there are takers. Somebody comes to you, I want money. I want money, I can pay you more. So, but then RBI in the name of price stability cannot throttle growth. There is demand for liquidity. If I don't give, they'll go somewhere else. Rates will go up, and that will be a threat to the, macro financial stability. So, RBI more than 10 years back made a financial innovation, marginal standing facility. So, okay. The 100 I gave, you guys have exhausted. You're still in need of a little more money. You're ready to pay me a little more. And also, it's, this 3% are magnifying. This is the 3%. Maybe you have used only 2% of it and the stock with the RBI got exhausted. Your quota got exhausted. You used only 2, 1 is there. Okay, you use that 1. No, sir, I have exhausted all the 3. I'm left with only 18. I don't have excess. But, sir, I'm looking for funds. Okay. You go into this. This is 18%. 18. Dip into it. No problem. 1%, 2%, 3%, that keeps changing. So this is the 18 SLR. Dip into it. This little bit. 1 rupee. Those securities, bring me. I'll keep them. Collateral, I'll give you money. Because I need to give you money, otherwise the economy will come to a halt, number 1. bank credibility will go down, number two. And I'm here to facilitate adequate credit, liquidity. So, emergency lending over and above what's lent through the repo window at a penal rate. That's why I've kept it here, penal rate. SDF, repo rate is higher than SDF. And MSF, penal, higher, repo plus. How much plus? 0.25. Today, not I can't tell you about tomorrow. Maybe the governor will say in the meeting in December first week, let us reduce the penal rate to 0.15. So that if I change the repo rate, what is the signal? I'm getting liberal, accommodative, expansionary monetary. I won't do that. My anchor, policy rate, repo, I won't change. So that I won't hit the headlines unnecessarily. But MSF, the gap between the two, I will change it to 0.15. The penal rate, hardly a penalty. 6.5, 6.65, hardly. So he may change. But for the time being, the gap is 0.25. You know 0.25? 0.25. That is the gap between this and this, this and this. So that is MSF, the penal rate. You can dip into your SLR stock also. Now, see, earlier there used to be a mechanism within the LAF called reverse repo. You know, reverse repo. Repo means I lend you, reverse repo means you lend me. And see, put yourself in the shoes of a financial player. You will automatically understand, I'll borrow from you at X rate. I take the risk, management, and you know, the overheads and all that. So if I'm paying you X, I have to charge X plus. And after cutting out, netting out all the costs, I still have certain, you know, take home, which I call profit. So when I borrow from you, I borrow at a rate less than the rate at which I lend, on lend. So reverse repo, the rate at which the government, RBI used to borrow from the banks, based upon government securities, is naturally lower, it just can't be equal or higher. That used to be the reverse repo for which the RBI would need government securities and keep that with you, take your cash, come the next day, give the securities back, give the money back and take the, all that is cumbersome. So what did the RBI do? In 2018, the RBI Act was amended. Saying what? Let's have this. Why? I'll take you back to 2016. All that cash piled up with the banks because people had no choice. And banks, all that money, the banks had to be prevented from lending because, I told you already, and for that CRR was invoked. Incremental CRR, 100%. All that would be unnecessary if only, what is standing deposit facility? Here I am, RBI. This is the counter. You guys have excess cash. Overnight you would like to deposit with me. Come deposit. Reverse repo means I have to create a government security and sell you and take out the cash. Cumbersome. And CRR, all that. So in 2016, a critical need was felt that the excess money that the bank should park overnight, for that they needed a window. So in 2018, RBI Act was amended to create the SDF, which is a deposit facility for the commercial banks to park their excess money, get them to earn something overnight. Overnight, extendable, roll it over, you know, all that. So SDF is 625, repo rate 625 because I can't give you as much as I charge. I have to give you less. 625, 650, 675. As things stand today. But this governor is known for tinkering a little bit here and there. So he may change it. He just might change it unless he has changed. You see? 25, 50, 75. This is the LAF and money management, liquidity management and all that. Yeah, Dharmendra ji. LAF, Repo, MSF, the penal rate. Somewhere here penal will come, somewhere. This is the liquidity corridor, the range. SDF, Repo, policy rate. And you know, when the MPC meets, they don't separately announce this is the repo rate and this is the SDF and that is the MSF. You know the gap. If they change the gap, they'll announce the change. After that, you adjust yourself. Repo is this. After that, MSF you know, SDF you know. So, the three together, the range is what is called the corridor. Liquidity corridor. Upper, lower and the central. That is a repo. RBI, central bank, government securities. Marginal standing facility. Another graphic I have created. Two words have to be used. Two terms. Marginal standing facility. Penal you have to use. Without that, impression is not 100%. And then if you could also use emergency lending, then you are rocking. Emergency lending for MSF and penal. This is all we have about this. Oh, yes. Marginal standing facility. Exhausted their borrowing from the repo window, you'll get only 1 rupee. You want more? You have exhausted? Come. You have exhausted your SLR plus also? Go into the SLR stock. Against excess, SLR, excess. Banks have exhausted their repo. Penal. Higher interest, obviously, penal is higher. Penal can't be concessional. Penal once again. How much time is left? 7 minutes. You know, I've purposefully decided we have to go slow and steady. There's a temptation to, you know, spike the speed. Slow and steady. This is a benchmark chapter. You're good at this, you're flying. Okay. Now, anything related? Oh, we haven't come here. No, we'll get there. No hurry. Okay. Bank rate I have not talked of. Give me 5 minutes. We'll come back here. This will come back. Bank rate, you please follow me carefully. You know, there is no central bank without a bank rate. What was the bank rate? You are the commercial banks. You got the government securities. You invested in them. But they're lying there. Bring them to me. How much is it worth? 100. Take this 75 rupees. Somebody wants to set up a steel plant. Lend him. 5 years, 7 years, 10 years. Those were the days the Indian economy was not vibrant and all the financial markets were not developed. RBI would, okay, give me your securities, I'll use it as a collateral, based on that I will lend you medium to long term, 5 years, 7 years, 10 years, not short term, medium to long term. But then after that the market developed, you want money to give us credit for. Someone who wants to set up a steel plant, float shares, float bonds, 100 ways of mobilizing. Float steel bonds, there's so much of demand. Don't come to me. I'm the central bank, I'm not the commercial bank. Commercial banks lend medium to long term. Central bank lends only as a lender of last resort. If you are drowning, come to me. But there's so much of money available for you to mop up and lend to Tatas and all steel plant. Do it, don't come to me. If you can't do it, stop there. So the central bank, RBI, stopped using the bank rate for medium to long term lending about 20 years back. But they were using the bank rate, which is there in the books. Okay, you are the government of India. You and I agreed. You will take a short-term WMA loan of 10 rupees. You've taken 11 rupees. You wanted 11, I had to give you 11. So I gave you 11, which is 1 rupee more. On that 1 rupee, I will charge you bank rate. That is a rate which is higher than the repo rate. For the 10 rupees, I'll charge you repo rate, short term. For that 1 rupee, I'll charge you bank rate, which is more. So I was using that bank rate as a penal rate. It had no other purpose because I'm not lending you medium and long, I'm lending you only short, and for that I'm using the repo rate. So what's the use of the bank rate? I was using it as a penal rate because it's there. But then in 2011 what happened was, those days, remember Sachem and all that. I still remember post Lehman, Sachem, all these people ran away with the money of the banks and the banks were under dirty heat. There was no lender in the market. Nobody lent because we don't know who is Satyam, who is Shivam. Yeah, we don't know. So banks were not lending. But then if banks if nobody lends, banks are looking for cash. I have to be lender of last resort. I did that under the repo. You want more. I can't deny you because after all you are the lifeline of the economy. And so under Subba Rao in 2011 they innovated a financial mechanism. That is, if you want ready to pay a higher rate of interest, I am ready to lend you. Those days, higher rate of interest was, 2 percentage points more, 3 percentage points more, because I have to be very cautious about lending. Otherwise, if you on-lend it to Satyams and all those people, then you will be in trouble, the economy will be in trouble, etc. So they innovated marginal standing facility, the penal rate. We don't have excess security, dip into the SLR stock, come to me, I'll give you money, give credit, keep going, keep the economy growing, etc., etc. I'll charge you penal. but you can't have two penal rates. Therefore, MSF is equal to bank rate. Two names are there because they don't want to delete bank rate from the book, but bank rate is equal to MSF. Both are penal rates. And bank rate, the original meaning doesn't exist anymore, lending medium long term. The only function that the bank rate performs is the penal function. MSF is equal to bank rate. On the bank rate, I did not get you a graphic because it's a dead rate. Those days in 2011, because of the fact that changes were made, you had a question, if you recall, if you go back, 2012, there was a preliminary question on bank rate. Question was, if the bank rate is changed, what happens? Nothing happens. I'm not lending you on the basis of bank rate. So bank rate, let it change. When I'm lending, it impacts on the liquidity. Rate goes up, less. Rate goes down, more. I'm not lending. So if the bank rate changes, nothing changes, except that number changes. So that's the background to your bank rate. Dharmendra ji, today's Hindu highlights will show them. At the end of the class, I would like to show you. This is in the today's Hindu, in which your serious, the preliminary question could be algal bloom, money lending, money laundering. This is only to cool your spirits, dharma, bhagavatam, etc. Makes you feel good. The drone could come, maybe. This quantum thing, the science professor will explain to you. It could be important. Inflation dynamics, your Hindu editorial. Ferry, who is going to ask you about ferry? If there is a question in the main about India-Sri Lanka relations, 10 words or 15 words you could throw in. And then the former National Security Advisor, Governor of Bengal, Narayanan, wrote something about the artificial intelligence on the global relations. Not a terrific write-up. In our notes, mid-November you will get it. Impact of AI on global relations. That is for the exam. Australia, the vote, as you know, in Australia the referendum was conducted. Everyone was told to vote. See, we have a constitution 1901. We want to amend that so that a body is allowed for the Adivasis there, that is the Aborigines. That body could tell the parliament what to do for them. Can we do this? That is the referendum. And 60% said no. But that is huge. 40% said yes, which is wonderful. What you should understand about this is, a referendum will never help the vulnerable sections. Let there be a referendum about reservation for women. Men will say no. Is there any doubt? Everyone will say no. Men. Who knows? Some women also may say, because they are under patriarchy. Caste-wise, the vulnerable caste? No. Whoever is in a minority, that minority is bound to suffer in a referendum, because referendum goes by majority and all that. So these Aborigines also didn't have their way. MSP goes up for Rabi, because farmers are a little nervous. Rains are a problem. My stock is ready to harvest tomorrow, suddenly rains. They want more. Ireland, UK is out of the thing, Brexit, so Ireland, the English-speaking country, our people are going there to study and invest in all that. This is all. So this is a snapshot. I've taken a bit of your time. So go home, study this. What to study, how to study, use your examination sense for that. If this is purely for relief. Religion is relief. Rest all, what will come in the exam, etc., it's completely up to you. If you allow me to guess for you, this is a good preliminary question, algal bloom, and 50% is your drone. Aborigines, Australia, 75%. MSP, of course, evergreen. Inflation, evergreen, etc. So you please come back tomorrow we'll keep going on the monetary policy.